begin with, we should try to diversify our assets, not just portfolio. We should try to diversify the asset class so that the hedging happens automatically. Let's say if we have a portfolio for some 10 lakhs, then we should have it diversified, the equity exposure, in terms of equity exposure, in terms of cash in hand, in terms of gold exposure, in terms of debt market, in terms of realty. So if we have the right proportion of diversification, gold diversification, any fall in one market will be taken care of automatically by the other asset class. Am I audible?
Yes, Dr. Parthipan, you are very audible. Please continue.
Yeah. So if we take this same current war scenario, if we are fully invested in equity, then the current equity trend is so we may be seeing loss. That is because of inflation, then currency devaluation due to strengthening dollar as against inflation, and uncertainty in the markets. At the same time, if we have diversified our portfolio into gold and debt market, gold, now the gold is rising. The fall in equity market will be compensated by the rise in gold market. Also, in the days to come, as the inflation shoots up, interest rate is going to rise. Once the interest rate rises, the debt market will give better returns than equities. So automatically it will be compensated, and along with gold and debt overtaking the equity losses, we will be having certain these two are natural hedges against fall of one asset class. Also, reality sector will also work in cycles. So we don't know when exactly it is going to shoot up, but at one point of time, once it shoots up, it will be overheated and we will not be in a position to take positions there freshly. So if we are invested in it, we will be able to catch the rise over a period of time. We cannot predict exactly, but as far as I know, but there might be, if we know the macro headwinds and tailwinds, we may be able to do, but diversifying a little into that also will help. Even keeping cash in hand itself is a hedge in terms of where to deploy the cash, or if you want to deploy the cash in bulk during crashes, that itself is like a hedge, or we will be able to, will be in a position to handle the situation. So this is what I feel we should be doing, instead of investing in one asset class like equity, money in equity or gold. Gold is really a good asset class, but the will not get alpha returns in gold. Gold will give returns steadily over a period of time. If we take 10-year returns, it will be equivalent to equity market. But if we take 2 years or 3 years, sometimes for a period of 3 years or 5 years, it can give 1 or 2 years, it can give negative returns also. So that gives steady returns, but over a period of time.
Yeah, Parthipan, that was really insightful. I just wanted to know, do you have any specific percentage in kind of ideal percentage between all these asset classes which would give decent returns over a good time span, because you are into diversification? Is there any good percentage?
Come up again? I didn't listen, please.
Is there any good percentage of how much in equities, how much in realty, how much in gold? Any good percentage you have figured out for yourself, or you have read about good percentage allocation? How much percentage into all these asset classes?
we can have a little bit more exposure in equities, let's say 40%. The remaining can be diversified in all other classes. Within equity, we can switch between cash and equity, depending upon the valuation of the markets, what you feel comfortable. And other classes, we can have 10 or 20%. Realty 10%, but gold should be at least 20 or 20 to 30%. The gold and the debt funds or debt instruments should be around there, 20% of your overall portfolio, what you want to build for a period of time.
What about default risk in debt instruments?
Debt instruments, it is not just the instruments like our companies. The government bonds are there. Government schemes are there, no? That one I'm speaking about.
Okay, so when you mean debt instruments, only the government bonds. Okay.
Yeah, government bonds are there. That gives fairly good returns compared to FD and bank interests, but it is safe also. Sovereign bank backed bonds, I don't see any risk of defaulting. Over a period of time, our capital, once the capital size increases, that much interest rate is sufficient. I think when we compare with Western countries, the interest rate that they are getting from government bonds and small savings schemes, or even some of the PSU debt instruments, those are much higher than what is there in Western countries. And once the inflation rises or interest rate rises, then again we are going to get more from debt instruments.
Okay, true. I completely get it. Yeah. If the horizon is please continue, Parthipan. There is some disturbance in your voice, but we are able to follow.
Selection also we should be careful. We should not get over greedy towards the selection of instrument. We should not look for 12%, 10, 11%, 10% kind of things. Debt is conservative instrument, so we should always look for sovereign guarantee in that.
Okay, so when Balasubramaniam once has some question. Please continue, Balasubramaniam.
Yeah,
yes.
I just have a question for Parthipan. Hi, Parthipan. Regarding your diversification, in case of equity diversification, do you have actually any kind of plan to diversify your equity as such? What I mean is that in case of equity, we have invested in case of equity markets in India. Do you have any diversification geographically? For example, you have invested in fund of funds in case of investing internationally, or do you have any assets or in case of any investments or stocks, in case of like US markets, like Apple or Tesla, or kind of any mutual fund instruments which have invested in US tech stocks in case of fund of funds? Thank you.
Actually, I don't have any personal exposure in mutual funds. Equity, I invest directly in equities. But what I see, Indian market has the capacity to grow as fast as and as stable as Western markets. When we see the returns over a period of time, actually we have outpaced the Western markets. So I have not really looked into it, but option is always there in terms of stability. Some of the blue chip stocks are there in the Western world, which can be considered, but I didn't do any analysis, and I am not in a position to comment on this. But the diversification within equities between the sectors is also very important, because sometimes if we have invested each sector has a commodity component and the other components. So
Meeting.
commodity stocks tend to do in cycles. Different sectors tend to do in cycles. When we take 2017 and all, IT sectors were cheap. You won't believe Infosys was around 400 rupees in 2017. So nobody was there. When there was some news about that CEO, those kinds of things. So overall sentiment in Infosys, the IT sector was down, pharma sector was down, and then again the cycle changes. So it's always better to we cannot exactly predict when the cycle changes, but within the sectors, among different sectors also, we need to select stocks which not only looking at the growth prospects but also the value. I've been even seeing my messages. Would have realized I would rather pay for stocks which are undervalued rather than stocks which have growth potential, which I believe will give returns over a long period of time. That is that you can take it as my strategy, but that need not be followed by everyone. Everyone will have their own this one, but diversification among sectors within equities will help, as well as geographical diversification. If at all we want to go for diversification, we can go for developed markets like US, and also but the diversification into cryptos, I don't know. I know I have some basic understanding about the technology behind the cryptos, but overall the market, the crypto market itself is not regulated. That's the only thing, and also we don't have any underlying for that. There is no underlying for cryptos, so I don't know whether it is a right kind of thing to tell in the forum, but I won't advise to have any exposure in cryptos. Surely for these two reasons. There is no underlying in cryptos. Also, there is no regulation in cryptos. Only if it vanishes, that's all. So it's purely 100% risk. So that diversification I won't advocate. Still, many people have benefited from crypto investing. It's like some people is going to invest at a higher price than us, so they are going to get benefit out of that. That's the only thing that is happening in the crypto market right now. Other than that, diversification should happen within the equity asset class.
Thank you.